thing I wanted to talk about is the partnership structures. And I'm talking about this more of now, I'm thinking about how when you started this, um, you probably didn't have the same type of investors you do now, right? You had probably less sophisticated than you do now. And I really do want to ask you, how was that transition to go from your retail investor to now a much more sophisticated, more institutional investor? What did it take? Because I think that is some of the struggle and some of the concern of people that need to go to the next level. How do I get to that next investor? And, you're 18, you're wearing a suit. Are you able to attract that big capital? Now you're 22, whatever, you're 25. You're able to be people to take you seriously. I don't care how old you are. There is a level of understanding and presentation and being able to sit in front of CEO, in front of very organized and I don't know, wealthy individuals, right? And you have to have a sense of confidence. How has that changed over time for you? And what would you recommend? Is there a book? Is there an experience? Is there a mastermind? What is your recommendation for our listeners here? Because I think that's a challenge.
Yeah, it's a challenge. And I think what's interesting is actually before you ask the question of how do you do it, I think what's interesting is a lot of people don't want to do it. And so some people may think they want to, but they don't actually want to. And there's also very successful syndicators that will tell you that they actually want nothing to do with sophisticated investors or family offices or private equity because they're happy with their syndications, with their retail investors, and that's their lane. So I think it's really great to hear and exciting to hear other people who want to partner with sophisticated investors and build up the team, the track record, the positioning in order to do so. So that's kind of the first start. The first start was way back early on. My business partner and I, we wanted it. We were really attracted to doing business with smart people that had more experience than us and that we could learn and grow with. So from the very early on, we positioned ourselves with that in mind. So everything we did with the lens of, okay, what if a $500 million private equity firm were to look at us or to look at our website or to look at our deal? And what would they say? And so being buttoned up to that level it doesn't take that much work, but it does take that thought. You have to have that thought and that intentionality. But what I really like is, speaking of, resources and stuff, I really like Richard Wilson. He runs the Family Office Club, and we actually shared the stage last week at a conference in Dallas, and he said, and I love this because I totally agree. He said, if you make yourself, professional enough and robust enough to be able to approach the sophisticated capital, then it's going to do well and you'll be fine with everybody else also, right? You might alienate some people who maybe aren't really looking or thinking at that level of sophistication. But for the most part, if you take that approach and apply it to all of your investors, you're going to do well. And that's exactly how we do it. We treat our small investors just like our big investors. So in the end, we have even if they might be a retail investor that's only investing 100,000 or 250,000, they're still usually quite sophisticated, and this is not their first real estate deal. And that's kind of what we like. And so that brings me up to another point, which is your avatar and your niche, because whether you like it or not, or whether you know it or not, you are niching. Like Jeff King, for example, mentioned that they do all asset classes, but they really are focused on multi. And that may have been intentional. That may have started unintentionally, and then they realized it and went all in. So that's true for everybody else too. Whether you like it or not, or know it or not, you are niching in some regard, and you are attracting certain people and alienating others. And if you do want the bigger capital, if you do want the firms that can write 10, 20, $40 million checks, it requires deliberately thinking about who they are, and then understanding what are their wants and needs and pain points. And if that's not what you want, then figure out the avatar that you want, and then be intentional to attract exactly that. So what are the pain points of that avatar? Well, there's a few things. So first of all, if you're a $500 million private equity firm, you have a certain investment criteria and a certain check size because you need to invest. You can't go around investing $1 million at a time because you're not going to allocate your fund. So your pain point is, I've got $500 million and I need to put it to work. So that's pain point number one. Pain point number two is they have an investment committee. They have fiduciary responsibility to their investors, and they're very sophisticated. So they're not just going to do a deal for the sake of it. The numbers really do have to check out. And finally, well, maybe there's two more, but there's deal flow, right? That kind of actually goes back to number two. They get a ton of deal flow. A lot of people want them. They want other people too. It's a two-way street. They're deal junkies just like we are. So, but because they have so much deal flow, they have the luxury of being picky. And then finally, what do they really want? They want repeat partnerships, because it's such a headache for them to go through this super rigorous sponsor due diligence process, go through investment committee, get approval, and then do one deal and never do another deal. That's exactly what they don't want. So those are some of the pain points. So now that you know those pain points, the next step would be to think, how can I alleviate those pain points for them? How can I portray myself as, like Richard Wilson says, if they have a headache, how can I be Excedrin, right? And you need to present yourself as, hey, I'm a focused sponsor that can provide you this exact type of deal over and over again, that once you get comfortable with me, we can rinse and repeat, and everyone's life is easier. So at a high level, that is, that's kind of our thought process and approach to attracting those types of investors.
So the elephant in the room says, yeah, but they don't allow me to take an asset management fee. They don't allow me to take an acquisition fee, or I got to take a half a point, and I don't get this fee and that fee and this fee and that fee, and I make nothing. And they want this, and I'm working for nothing. Is that the first deal, or do they, how does that become, hey, can you let me make a little bit on the next one? Or is that an ongoing, sorry, this is the way it is? How has that been for you?
Yeah, there's definitely, that's true. There is a reality there that if you are going to partner with someone that's going to provide you $20 million in one chunk, it's going to come at a cost, as opposed to, $100,000 at a time. So roughly speaking, everyone's structure is a little bit different, and that goes for both people's syndication structures as well as their joint venture structures. But based on my analysis of kind of what I've seen out in the market, and then breaking down the numbers, roughly speaking, your fees are around half as much as opposed to a syndication, maybe a little bit more, but around half as much. And then your anticipated promote compensation as a sponsor is roughly cut down by about a third. So you get haircut more so on the fees than you do on your promote. And then if you take it a step further, well, and I also want to answer your other question, which is, can you graduate? And the answer is in my experience, yes, but slightly. It's not like they'll pay you no fee up on the first deal, then you work your way up to 0.5%, then 1%. I usually don't see a lot of deviation like that, but there is a little bit where, maybe it's 75 basis points on the first deal, but then the next time it's 1%. And that depends also on just how good the deal is, how differentiated the deal flow is, and the size of it, of course. But I also think, maybe some of us aren't as used to negotiating with equity, right? Because
Yeah.
if you're just putting out a syndication and you're putting it together a PPM, you don't really have investors negotiating with you. They either invest on the terms that are advertised or they don't. But in the private equity world, it's all a negotiation. So I think if someone says they won't pay, like I actually met a private equity firm here in New York a while ago, and it was actually on stage. So we were at an event, both speaking, and I was the moderator, and I said, "Oh, like what is your typical structure? What's your acquisition fee?" And they said, "Oh, we don't usually pay an acquisition fee, yada yada."
Yeah.
And I was obviously turned off by that, but
Yeah.
nonetheless, I had a follow-up call with him. And on the call, he was more realistic and said, "Yeah, look, we usually pay 75 basis points to 1%." So I think maybe there's an initial offer and then they come back and things like that. So that's the one thing. But going back to the math of it, right? If you're getting maybe paid almost half as much on the fees, maybe a little bit more,
Yeah.
and then a third less on the promote, that's the reality between syndication and JV. But now let's say you're a lead sponsor and you're layering in co-GP partners that are helping you raise capital. Well, then it becomes a much fair comparison, because when you bring in partners, you obviously have to share in the fees, you have to share in the promote, and you might end up in the same place if you have to bring in enough co-GP capital to get your deal done. So, and that reality and that math has been exacerbated by lower leverage. Because if you think about it, back in the good old days when we were doing a $20 million deal for $5 million of equity,
Mm-hmm.
you're getting a 2% acquisition fee on 20 million, which is 400,000. And all you need to do is raise $5 million. Now, if you're doing that same $20 million deal and earning that same $400,000 acquisition fee, you might have to raise $10 million, which is double the amount of equity. So you're essentially diluting your fee compensation by half, because of the debt environment that we're in. So when you look at it that way, it kind of starts to neutralize, not neutralize, but it starts to make the difference between retail and JV less dramatic.
Mm-hmm. Makes you want to say, makes you want to go, yeah.